Hello and welcome back. Today we're going to talk about the floating grid in a way that shows it being applied manually. The steps to take to actually apply it to any asset or instrument, whether it can be algorithmically traded or you trade it by hand manually. The steps are really the same in terms of the charting. Now this question comes from Tim, who wanted to know about crude oil futures. So let's get started with the chart. We have the chart on the screen for crude oil futures, and I have a bunch of lines on it. For the time being, let's just focus on the big picture, the upper and lower bands, the highest high and the lowest low. These are the starting points. Now this is the monthly chart so that we can get the bigger picture of the grid itself. One of the biggest mistakes with working with a floating grid, or any grid really, is that people often start on a smaller time frame. Always start on the highest time frame. In this case, I am using the monthly time frame. I want to find the highest high and the lowest low of the entire history. Now, with respect to the lowest low, yes, this is actually a negative balance on crude oil, below liquidation, and that is terrifying if you have any amount of money in a long position. Your account is going to be decimated. So risk management here is absolute. There's just no way around emphasizing that. You have to have your risk management. Now I've set this up to allow me to trade this manually and in a way that I can easily keep track of. So the upper bright red bar is the highest high. The lower bright red bar is the lowest low. So once we have that range, the highest high minus the lowest low is the depth. The depth is the range by which we are going to trade, the range that we are going to subdivide into levels or layers. This is what is going to give us our primary grid, the long-term grid. This is where we look at the entirety of the asset for a long-term passive approach. Now, for the purposes of this discussion, rather than trying to jump back and forth between long and short positions, I'm only going to take the market in the context of a long position. That is, when we buy, our goal is to sell at a higher price. So let's see how that actually looks as we proceed through this. So now that we have the basis of our depth, we know how big our absolute grid is going to be. We can take the depth, divide by the number of levels we want. In this case, I am using 10 because it's easy to keep track of manually or in a spreadsheet. It's also easy to keep track of in your trading application so that you know where you're at if you prefer to use limit orders versus market orders. It makes it easier to simply watch. So your depth divided by the number of levels gives you the spacing between each level. So as we can see with the light blue colors, we have that spacing, which is roughly $14 here. So we have our primary grid, we have the depth of our grid at 10 levels. So we space everything out, and then we can really begin to see how that looks. So let's do some zooming in. I'm going to avoid the microgrid, but I want to show this is part. So now we have our boundary at the 10 level layer, the bigger picture, the macro grid, if you will. So this is where you set your buy and sell signals. Now with the macro grid being the entire history of the asset. Stop losses aren't as important, though they should still be considered carefully. The point here is that when you place your order, you need to think about any margins, any finance rates, the liquidation points of your positions, and you need to be prepared to handle long-term holding, which means your position sizes here need to justify holding for several months. As we can see, we've crossed down and over, and these are months in duration. That really is the biggest problem with the macro. The macro requires a significant budget. As we zoom in here, let's actually look at just how long that might actually be. Just within this section, you're looking at roughly a year and a half of holding for just the highlighted section on the screen. That's why this is macro. Now that's not necessarily something most people want. They want to be able to make money along the way without having such huge investments. This works if you have $1 million invested, but not everybody has that, nor should they actually invest that kind of money. So you're going to want to look for smaller entries. And that's where the microgrid comes in. The same concept as the bigger picture, just scaled down. Let's get to the end. So now we have our microgrid for the most recent months. Now for that, I colored those lines a darker blue versus the lighter blue cyan so we can see the contrast. But again, the rules are the same. Take the high boundary minus the low boundary to give us the depth. So we have the depth of the grid, and now we divide that by 10, and you can see how easily we can see the long-term picture of this micro grid. But still, you can see these are 1 month variance per candle, and some of these cover multiple levels at a time. This is one of the biggest concerns and issues about grid trading, particularly when you have circumstances like this candle here that literally cover just about the entire grid in one blow. These can be devastating if you aren't prepared for them and have a plan. If you have the market going in your direction, in this case this is a short, this would be a landslide victory for pricing. But if you happen to have been holding a long position, this would have been a nightmare. And that's why the worst case scenario plan is always so critical when you have a market like this that isn't just about technical analysis or mathematics. The crude oil futures market is about speculation as well. What people think the price is going to be in the future is what drives what the price is at the moment. And that is incredibly difficult. Now this example is about a $1.6 difference between grids at a 10 grid level. Personally, I would use this kind of a structure to be more in line with 20 or 30 grids and focus only at the micro level versus the macro level. But the risks are drastically higher. The risks for going through your microgrid are significant over the entirety of the whole lifespan of the asset itself. So risk management really becomes the center point of this kind of grid. And the problems with this kind of grid actually take center stage even more so. Let's focus in on one particular part of this grid. Okay, we are looking at the grid in full detail, and The interest that we want to focus in on is this last candle right here. We already see the wick has gone down below the grid boundary itself, but it's done that in the past twice. So this tells me the grid is going to move down. So from the standpoint of our long position, if we've purchased up here, we're going to have, at this point, this potential number of positions. So at this point, we have 6 positions of our 10 level grid, roughly. So here is where you need to consider the problem of your grid, your risk, your volatility, all of that rolled up into one. Because once you get to the bottom level, if you're at the bottom of the grid, you need to think about the next step. That being said, you're going to want to buy at the bottom. That is, you're going to want to add to the new position. But you can't until you sell the highest position. In order for the floating grid to stay with the market, you can't buy here until you sell the oldest position. You have to make room for your grid to move. That means taking a direct and deliberate loss. That is a problem if you don't give your grid enough breathing room. That is, if one single month of momentum or volatility within the market isn't smaller than your grid, you are going to blow your grid up, and you're going to lose more money than make. So the purposes of this example, this is a bad example because we have a single candle that literally stretched the entire grid. Basically, what you want to do for your grids on the micro level is find the largest single candle of the highest time frame and multiply it by at least 3. This is a conservative, safe approach that guarantees that your grid has 3 times the required distance needed before liquidation or a severe catastrophic issue. Accepting 1 or 2 stop losses throughout the month in regular movement is normal. It's expected. When you have your entire grid liquidated, that is catastrophic, and that is lack of planning and preparation. The grid itself must float. That is, your highest position and your lowest position must be able to move fluidly over time to follow the market. And that means having a grid large enough to weather at least 1 full month's worth of movement without liquidation. That isn't always that easy. For example, with this grid, if we pull back and we look at the bigger picture, we can see that it's quite easy to blow up because we see quite often very large and significant candles. These candles have an impact, and that is the problem. We also see situations where multiple months could easily blow it up. So when you build your grid, you must think about the longevity of the grid. And that's why, for my purposes, I would look at the entire grid and start there. I actually would not start at a smaller level. I would look at the highest high and the lowest low of the entire market and spend time studying it. It's not going to be as profitable because of the distances between the grids, but it will be far more sustainable. And that is the biggest issue that you need to really consider when you're looking at the market. Now, when you look down at the smaller time frames, we're going to take the 5-minute just as an example. Then things become drastically and significantly different. If you're trading smaller time frames only, then the microgrid makes sense, because then you have time to react, but you're still dealing with the consequences and potentiality of not having a long-term worst-case scenario approach. You should still plan for 3 times the largest candle, just as a safety net on your microgrid. But we can see clearly that the microgrid doesn't move at the volatility of the macrogrid. That's important because the one thing we have, especially with manual trading, is time to react. That is very critical. When you don't have that time to react, then you end up in a situation where your account can be liquidated too quickly. So let's continue back and see where this takes us. We can see that we actually didn't really have much activity until really right here, when we crossed under the grid on the 26th of October. So even though we have some traffic, it's taken 5 days from then to now, but we did have traffic here. So if this was a short position, it would have made money. But again, we're dealing with long positions. This doesn't help us. So we can see clearly how your direction really plays a significant role in your trading. Do you take the chance of a short position and be the corrective force of an overvalued market, which could be devastating if the market rallies into a straight upward spike? Or do you take the long position and end up with slower trading, but could be devastating if the market has an existential collapse? That is part of your risk management. Ideally, you could say both in 2 different isolated accounts, but that divides your money. So there's always these problems, these balancing points that need to be talked about and looked at as you work with your trading. You need to be able to fully functional dynamic of the market for your approach, to have a way of looking at the market and moving with the market. Because if you are caught in a situation of a hard line market push, for example, we can see here, looking at our grid, if we purchased down here, then this would be an incredible jackpot. But if we made the mistake of purchasing at the top of the grid, then this would be devastation. Direction is everything, and it is difficult to decide how to actually get that direction. But it's made even worse when you have these kinds of events. When you have just a runaway market, this is a nightmare because you don't know what the market is going to do. And positioning yourself for smaller trades is going to be incredibly vicious if you are on the wrong side of that move. There is a way to help make that choice though, and that is by using the macro grid. I have 3 lines: the upper, the lower, and the line I haven't talked about yet, the midpoint. This can often be a very useful approach because anything above the midpoint is overvalued, meaning the market believes it to be too expensive. Anything below the midpoint is undervalued, meaning the market believes it to be too cheap. This can help with making trade transaction decisions. So an overvalued market, you would probably want to short it. An undervalued market, you would probably want to open a long position. And you can do that with a floating grid manually because you see the chart every day. It's more difficult algorithmically because you have to program the code to handle that kind of a separation. But it is still very possible. So now that we have something to help us with our decisions, the way we look at this is very simple. The higher above the median you are, the more pressure on the market to return to the median, the price that the buyers and the sellers think is fair. The lower or further below the median that you are, the more likely price is going to climb and again return to the area buyers and sellers believe is fair. So this is a powerful tool that helps you figure out where the market is and to pick your direction so that you can try to get the best opportunities and limit your risk as much as possible. But the biggest takeaway for the floating grid is not that you just grid trade. It's that you accept the losses of having the market move. When the market moves against you, take the stop loss. Don't try to pretend the market's just going to get better and it's just going to be a simple recovery. That's going to put you in liquidation and you're going to lose your account. It is better to take 1 or 2 or 5 stop losses and go from there. The biggest issue you want to be aware of is you need to make sure your grid has the depth necessary to limit your stop losses. Because if it doesn't, and you take too many stop losses, you're still going to be liquidated. Let's focus in on the microgrid and discuss that implication. Okay, here we have the microgrid, and we have exactly one of the events I was talking about. If you buy in down here and you sell at the top, you are a winner. You just cleared out your whole grid and you walk away wonderful. But that doesn't happen as often as we'd like, that you're in the right place and the right time. More than likely, you're going to be in this situation. You're going to start your grid up here, and then the market is just going to hammer you, and you're going to be decimated. Yes, it happens more often than not that the market is going to move against you. That is the reality of the floating grid. And in this case, we can see just how far down it went. It literally went 2 full levels before it recovered. That's why you need the biggest candle 3 times over as risk mitigation. And that's just a suggestion. If you want to go more than that, definitely. If you just want to stay at the macro level where that's not an issue, that's fine too. Because this is where you have to decide your own risks. The kind of risks that make you feel safer about your trading. Now let's focus in on this one particular section. The devastation point of just how quickly the market moved. Okay, we have the section that I want to focus on. I want to focus on this narrow window where the market just hammered out. Basically, day after day, with little reprieve, straight drop in oil. This was the COVID pandemic range, and it was a nightmare. This is just one of the many problems that we see with speculative or futures markets. This is a real issue that can destroy your portfolio. It can wipe you out. And having a worst case scenario approach is vital. You need to be able to actually handle this kind of a process. And that's why you need to think about your position sizing, your liquidation rates, your finance rates. Keep your account so that you can easily move through this grid without being completely decimated. And really, this grid should be 3 times the size it is, realistically, for a stable, safe approach. So as we look at this grid and we see the very clear downward pattern, the problem is, if we all knew this was going to be the nightmare it turned out to be, nobody would have bought up here. They would have all shorted the market and walked away big time winners. But that's the whole point. We don't know. We can't predict the future. And that often is one of the biggest things that wipes out trading. If you have an account and you put a position in too big, you've lost your account. Diversification of micro positions, figuring out the grid through levels, is going to be the only way to actually follow this down safely. And even then, position sizing to weather this kind of a grid with this kind of a sizing is a problem. So we have the top line. This is our stop loss point. We are going to always take the oldest position as the stop loss as the grid moves against us and we buy new positions. It's just the simple, basic principle. Take the stop. Do it. Build it into your system automatic. Weather out your system so that you can handle this kind of a trend. If you have this at 10 levels, each level 1% of your account balance, your worst case exposure 10% of your account. That means you could take 10 full liquidations of your grid before your account is exhausted. That is a reasonable and safe level of actually trading. It gives you a clear, consistent, absolute way of positioning yourself to weather even small grids. It's not going to make you rich. You're not going to take $1,000 and turn it into $1 million. But you're not going to lose your account either with unnecessary over leverage. Because the most important thing with this, when you're dealing with a futures account, is your margin. Liquidation of every place I have ever studied has always been at 50% of margin consumption. As soon as you hit that, your money is gone. Period. If you're only putting 10% at risk, then your worst case leaves 40% of your available balance to weather the market before hard losses are taken. For example, we can see at this little point here where you might have gotten in a few small trades profitably. But again, that is situations to take into account. And we can also see that back here where there are opportunities for small trades. It's the smaller trades that help make up for the bigger trades and the losses. What you're looking at is basically the same game that the insurance companies use to stay in business. They're going to take huge losses once in a while. But overall, because of the way they're structured, they're going to make a killing in the market because those huge losses don't come often with proper planning and risk mitigation. So that really is the whole point of this grid. Spread out your risk. Limit your exposure. Give you a way to move with the market. A fluidity that gives you the potential to weather whatever the market does. And that is how you actually do survive. But that is the greatest strength of the floating grid, because the floating grid can look at both the entire market from the highest high to the lowest low, but it can also look at the micro-sized market where you can see opportunities in a smaller time frame. Now, for me personally, if I was to look at this, I would actually use two different trading accounts so I can trade in isolation. The bigger long-range macro market would be one account. Keep that going in complete per diem, where I only have to worry about adjusting things if the highest high or the lowest low changes. It gives me a stable, fixed point where I can guarantee an exact, precise budget within a reasonable level of statistical probability. The micro market, significantly higher risk, but I can make up profits along the way as I progress with this. Now, with the terms of the market, direction would become a consequence of your risk and your thinking process of what you believe the future of oil is. For example, let's go back up to the monthly. What is the future of oil? That becomes a question that we need to ask ourselves when we look at this chart. As our world moves to other sources of energy, how dependent are we going to be on oil in the future? Well, that's an important question, but it also depends on the markets of oil. A lot of times people think that oils are just automotive products, but they're not. They're used in synthetics like nylon, rayon, tires, plastics of all kinds, petroleums from medicines like Vaseline, or other kinds of skin protectant jellies. These types of materials are just as much an oil product as the oil you stick in a car engine. Cars may go away, but plastics, nylons, and other synthetics, they're not going away for a very long time. So oil in some form is going to be a significant part of our future. So there's going to be some market that is going to simply need to use oil. It is a viable market to deal with. There is always the existential risk of complete collapse, but as we can see from the entire history of the oil market, that has only happened once. So statistically, it's not impossible, but the likelihood is minimal. It still requires a risk plan, just in case, but it has a way of determining whether or not we need to assess the market viability. We have clear situations where the market had huge whopper moves. This could have made or break somebody financially. So there are opportunities within these markets that can't be ignored, both in the short term and the long term. So trading in both short and long markets is certainly a viable option. Somebody that bought way back in the early part and sold way up here would have been a millionaire 100 times over. But somebody that bought in at the top and then hit liquidation would have been wiped out. There is no easy answer, but that's what grid trading, particularly the floating grid, offers an answer to. You can't predict the future, but you can put statistics on your side both in the long term and the short term. If you have any questions, please ask them. Let me know. If you'd like to see more in terms of how this can be developed with a grid that's 3 times the largest candle, leave a comment. Thank you again, Tim, for the question, because this is an interesting market to explore and one that really does push a floating grid to its mechanical limits. Until next time.